As soon as 2022 started, there has been a bear sentiment due to the Fed's increasing the interest rates 3 times this year. Over the past month, in January, the market dropped 9.21%. The combination of increasing interest rates, supply chain problems, overvalued assets, and emotions drove the market to drop this amount. But that is short-term noise. When we look at the bigger picture, for example, at the 1-year mark, the market is up 15.97%. If we zoom out more to the 5-year mark, it's at 89.57%. Nobody can time the market, but let's say you can time it and bought shares at the very bottom of the pandemic. You will still be up with 88.72%. So, if in the long term, the market goes up regardless of short-term noise, and there's always been a situation of interest rate changes or overvalued assets, why do people sell? Let's talk about 2 behavioral finance concepts. Emotional gap. The emotional gap refers to decision-making based on extreme emotions or emotional strains such as anxiety, anger, fear, or excitement. Oftentimes, emotions are a key reason why people do not make rational choices. When fear arises from a dropping overvalued asset and you own it, you might think that you might want to sell it, either to lock in profits or to reduce losses. Sometimes you're too quick to jump on the decision without checking your investing thesis, which leads to irrational choices. The second term that could go in hand with the emotional gap is herd behavior. Herd behavior states that people tend to mimic the financial behaviors of the majority of the herd. In other words, other people. Herding is notorious in the stock market as the cause behind dramatic rallies or sell-off. When everyone is selling, you feel the emotional gap or the pressure to do the same. This is why sudden rallies or sell-off happens and cause investors to lose money because they're not following their strategy or doing any analysis before selling. Some of the analysis comes from earnings. How did the company did in the past quarter? And their future guidance. We often make decisions without checking the broader picture, which can result in loss of potential gains. I will be going over some of the companies that I own that had earnings this week. Let's start with one of the best companies in the world, Apple. Apple beat earnings per share expectations by 21 cents, accounting to $2.10 EPS. They reported a revenue of almost $124 billion, beating expectations by $5.4 billion. Also, all the revenue from their products beat expectations except for the iPad. I am long on Apple. Their products and services keep beating expectations on a consistent basis. Even if in the future they slow down a bit, which I believe they won't, it will still be an amazing holding to have in your portfolio. Next one will be Archer Daniel Midlands, ticker ADM, beating expectations by 0.14 and beating revenue by $2.88 billion. This is a 28% increase on the year-over-year. ADM business model allows them to withstand high inflation X scenarios since they can just increase their prices. This is the main reason why they had a nice beat. ADM has been doing this over the past decades and it has given them good results. The CEO commented that for the excellent performance in the fourth quarter and throughout 2021, it gave them enough momentum to start the new year in a good stance. And to reward their shareholders, they have increased the dividend by 8%. This is above inflation and I'll take it. New payout will be 40 cents per share per quarter. One of my consumer defensive holdings, Procter & Gamble, they had a small beat of 1 cent from EPS and a revenue beat of $610 million. They also increased the 2022 outlook. All of the consumer companies has been affected heavily by inflation, but Procter & Gamble seem to battle it very well. Kimberly-Clark, on the other hand, beat EPS by 5 cents and a revenue beat of $70 million. Kimberly-Clark is having trouble with high cost of goods and supply chain issues. This forces them to increase prices and have difficulties versus the competitions. Shares dropped on pre-market due to poor 2022 guidance, but the board of directors from KMB increased the dividend by 1.8%. This is a small increase and does not beat inflation, but the amount is understandable. Inflation needs to be controlled and supply chains needs to be sorted out so consumer stocks can provide a higher dividend increase in the upcoming future. Let's give an update on my portfolio, where I invest $100 every single week. Portfolio value is sitting at $4,498.19 with a dividend yield of 3.58%, which translates to $149.06 annual dividends with 15 holdings. I bought some fractional shares from KMB, 3M, and Corning. For the next week, I will be keeping a closer look at 3M as it dropped quite a bit in a reaction to news about a lawsuit for faulty sound suppressing plugs. Heading over to the dividend payout, this is the amount that every position pays me in dividends per quarter or monthly in the case of REITs. It seems a little bit uneven due to the high payout from AT&T, but currently working on increasing other positions. I stopped buying AT&T some time back since the Warner Media spinoff will occur sometime this year. I want the dividend yield reduction to affect me the less as possible so I can reach the $300 yearly dividend mark. Overall, portfolio and dividends are growing. The allocation seems to be balancing out bit by bit as the investing journey goes on. We'll be keeping an eye on my watch list to see if there's any value company that I can start a position with. I will remain consistent with the dollar cost average, reinvesting dividends, and investing weekly. Can't wait to see how this portfolio will be at the end of this year. Hope everyone has a great weekend. There will be some earnings reports next week that I will be looking forward to, and we'll cover them on the next video. Stay safe and stay invested.